I already introduced myself. 40 years in the industry. With Arthur, even when I was at Arthur Andersen, half of the clients were oil and gas. Actually, when the first week or two I was there, and I was in the tax department, the client I was assigned to was Helmerich and Payne, and they had me drive some report out to their office. Couldn't find a parking space, so I, pulled into one of the private ones for the officers. Well, I dropped all my packages on went, and here comes one of the Helmerich guys saying, "Yeah, some guy in my, I want you to tow his car right away." And I said, "Oh, I better get out." Anyway, oil and gas prices, will they rise again? The thing is, they call them cycles for a reason. I was just telling people out there that I lived through about 6 of them, multiple. We said, about 6 or 7 layoffs. I know at Hess, we used to do that about every 5 years. So, well, the $1 billion question, maybe it's the $1 trillion question, is where are commodity prices headed in general? And commodities are now trading at like an all-time low to the S&P 500. All commodities, metals, oil, gas, corn, wheat, everything. All commodities are way down. So the oil prices will need to go higher in 2020 and probably double from where it is today if we're going to meet demand beyond 2021. Natural gas prices up 50% since September, and it has a chance to go to $4 this winter if we have a cold winter. Oil demand did plunge in the second quarter, obviously because of the pandemic, but it bounced back pretty much. And except for jet fuel, global demand is over 95% of where it was before the pandemic. So it bounced back pretty quickly. Maybe people aren't flying anywhere, but they're driving on vacations, and there's still lots of trucks and trains and stuff going up. I don't know how the cruise industry is ever going to rebound, but they do have a loyal fan base, including my wife. Global demand did exceed production by 2 million barrels a day during the third quarter. The quarter just ended, and the difference came out of storage. So they were drained quite a bit of storage, headed back to normal already. There is a seasonality to oil demand, and it does go down every winter. So I'm going to show you a chart in a little bit, but we're probably still got demand about 500,000 to 1 million barrels a day above production. Now, we still have to work off quite a bit of inventory, especially of refined products, but it's going to happen. And global oil demand exceeds, non-OPEC plus. Now, if you're not familiar, OPEC plus is the cartel plus Russia and plus a bunch of little bitty countries. But it's basically Saudi Arabia, Russia, a few of Saudi Arabia's friends in the Persian Gulf control the oil price and control what goes on in OPEC. Now, people badmouth OPEC, but if we didn't have the cartel and them curtailing production now, we would probably be down in the $10 to $15 a barrel range on oil right now if everybody was just producing at max. So they do help stabilize the market a bit. We're just not completing enough wells to stop supply from the continuing decline outside of OPEC. So non-OPEC plus production is going to continue to decline. And the bottom line is U.S. and OECD, you're not familiar with that. That's the Organization of Economic Cooperation and Development. The good guys, I guess. I don't know, Japan, Australia, Europe, and us. Those inventories are going to normalize pretty much by the first quarter of next year. And if we don't significantly increase drilling and completion activity, they go to dangerous levels. And that's pretty important. So here we are. I don't know what oil's doing now. It's probably down a little bit this morning, but it did have a big spike up on Monday with the announcement of the vaccine. And I get a lot of Wall Street reports, and they are very bullish about the vaccine. And probably it's going to be better than 90%. But Pfizer's a big company, and they don't want to fail on this thing. So if you look there, oil WTI, this is a chart of the front month NYMEX futures contract. It's currently the December contract is what's trading. But in January, after the signing of the trade agreement, the phase 1 trade agreement with China, oil spiked up about $5 and it went to $65 a barrel. It seems like ancient history now. But then, we start hearing about this little virus coming out of Wuhan. People start getting nervous. And then probably that little decline in the first quarter there, that was more just seasonal. That was just, the demand for refined products goes down in the first quarter of a year. So that's probably just seasonal. But then that big arrow down, and in the real world, outside of paper trading, Oil went down to about $10.45 in April, and then pretty much a V-shaped recovery. I mean, it got back into that trading range of around $40 there in the third quarter and stuck there. Now, recently it dipped out of the bottom of that trade, and that always freaks everybody out because there was a very strong support level at 38.50, and when that was broken, I'm getting all these calls from our members. It's going to 30. What happens when what happens on this company when it goes to 30? And well, most of them have all their production hedged anyway, so it doesn't really matter. But we're back in the 40s, and that's good. Now, if you're watching this stuff on a daily basis, if we have several closes above 41.50, that would be very bullish because then it's about a $2 or $3 barrel range up to the next strong resistance. But why should oil prices go up? Well, they should rebound just because demand exceeds production today. Inventories are balancing. U.S. production is down 17% already, 2.2 million barrels a day since it peaked. Our oil peaked in November. It peaked 4 months before the pandemic really took effect and went on slow but steady decline from November. I'll show you that part in a minute. And important to remember, winter is the low demand period, and demand for transportation fuels always picks up in the summer. Even this last summer, it picked up, which had something to do with the oil price rebounding fairly quickly. So this is Raymond James' official price forecast that came out on October the 5th, and I'll show you their gas one in a minute. But they've been, pretty good. Nobody could really forecast the pandemic's impact. So people say, oh, they overshot. Well, that was pre-pandemic forecast. But they're still saying it should average about 40 the fourth quarter and then gradually go up and probably exceed 50 by the end of the second quarter. Marshall Atkins made a presentation at Enercom, and he actually said he thinks it will go triple-digit oil price a year from now. But this is their official Raymond James forecast. Okay, now this is probably the most important slide in this whole deck. What really drives the price of oil? Well, everybody says, oh, these speculators, these guys trading paper every day on the over the counter or whatever. No, what really drives it is OEC days of consumption. This chart has a real correlation to the price of oil. And think about this: you and I don't burn crude oil in our cars, right? Crude oil is the raw material for that big list of stuff that Pat put up there. That raw material, the stuff that is directly related to our standard of living. Okay, so this is the raw material, and this is arguably the most important food chain in the whole world compared to food. Because if we don't have enough of this and you run out of gasoline, then people are not getting groceries delivered, right? They're not getting stuff made that they use every day. So this is really important. And I want you to look back at now the blue line, that's the price of oil, and it's an inverted chart. So on the right side of there, that's the oil price. So as that blue line goes down, that means the price of oil went up. So as OECD inventories go down and dip below 30 days of supply, you get big spikes in the price of oil. So the first one over there, and it's hard to see the bottom of that big dip down, that's when oil went to $147 a barrel. Now, it doesn't go that high or that low down on this chart because this is quarterly averages. So the 147 was just 1 or 2 days, but it did spike to 147 in early 2008 before the economic crisis caused the big drop in demand. So just that little bit, when it went below there from 30 days of supply to 29 days of supply, caused it a very exaggerated jump in the price of oil because it got traders competing against each other for what they saw was diminishing supply. And then the period of time prior to 2014, we had 4.5 years where oil was trading between 80 and 110. And I can tell you, I went to 2 Enercom conferences to do that. Man, it was party time, baby, at Enercom. That was, boy, and everybody there was going, oil's going to stay in triple digits. We're there. And, but anyway, it held on pretty well. But you can see for 4 years, because those are quarterly bars, for about 4 years, it was going pretty much steady decline. And every summer it was going below that line. Well, then Saudi Arabia floods the market. They decide to regain market share. and then inventories built up. But again, just to like 32 days of supply, no big glut. It wasn't, overflowing the tanks or anything. And oil price dropped, but only at about 50, $40 or $50 was when it went to. And then we've had this COVID thing, but that's when, supply, they were afraid the tanks up at Cushing were going to overflow. That will never happen, my friends, because those are managed by people that are very, very smart. They'll tell and they told the producers they had to shut in a bunch of wells, which is what took down our production. But so see where it says today, that's where we are. So we're about 33 days of supply. I will tell you, if those bars, if the real world starts dropping like that, it won't have to go much below that red line, which is only like 2 or 3 quarters away, and you will see some very competitive pricing for oil again. So this is, so now we're looking at U.S. crude oil inventories. This is a 2-year chart, and that gray area in the middle is the 5-year range. Now, we have about total storage capacity of 640 million barrels in the country. We'll never, ever get close to that. Working storage is about 580, which is the very top line there, right above the little yellow square. And, we haven't even been close to that, but that's pretty much working storage. So we got outside, so I wish I had a little arrow thing, but outside of the gray range and up to about the peak where we were in April, and they were real worried about storage going up. So that caused us to shut in about 2.5 million barrels a day of production. So now it's headed back, and this is a little dated, about 2 weeks old, but we're about at the very top of the gray area where we should be. Now it is normal. We normally build inventories up in October and November because that's when refiners do their annual maintenance, a lot of them. And so they take down the amount, and you build up inventory getting ready for the winter when they have to produce a lot of home heating oil. So again, US, so okay, the weekly numbers that the EIA sends out that everybody reacts to on every Wednesday, those are just pure estimates based on formulas. They do not really have a gauge on every tank in the country, and they really don't know. And actually, during the last 6 months of 2019, when the actuals came out, they had been overstating production by 200,000 or 300,000 barrels a day in their weekly reports. You may remember them saying 13.1, 13.2 million barrels a day. Never did it get close to that, because their formula is all, if they were weather people in the spring, they would just carry it. We'd have 150 degrees in the summer. All their formulas are based on the trend. It just keeps going forever. Even when you could tell in the real world it wasn't doing. Okay, then there's a seasonality to this too, because then a lot of these public companies want to complete a bunch of wells in November and December to get them into their year-end reserve report. And then they, kind of back off, because it's hard to complete wells in North Dakota when it's 40 degrees below zero and you're handling a lot of fluids. So production does go down a little bit seasonally, but it was already going down before COVID strike. And then that big jump from April to May was because of all the shut-ins. And then the rebound in June and July is because the shut-ins are coming back online. Now, I've gotten some multiple emails and, guys that write for, sleazy newsletters and stuff. They say that, oh, look at all this oil, production's going back up, so we're just going to ramp back up to 12. No. That's just the shut-ins coming back online. And you'll notice, even when they came all back online, because they're pretty much all back online by the end of August, well, then we do get into hurricane season. So we've had a very active hurricane season in the Gulf, and that's messes this stuff up. And so, but I think we're going, if you just go by their weekly reports, which I just said were baloney, but September and October are about in that 10.6, 10.7 range. And I think we might get up to about 11 million by the end of the year, but then the first quarter again, we'll go on steady decline, unless there's a big increase in price, because we're just not drilling enough wells. So here's the active rig count that's put out by Baker Hughes every week. We're down 517 rigs in the United States from where we were a year ago. We're just at 300. If you went back another 6 or 12 months, we actually got up to about 1,100 rigs drilling at one time in 2018. 2018, we got back to $70 oil for a while. Again, seems like a distant, pleasant memory, right? But anyway, so the yellow box on there said the number of rigs that we need to be running just to hold U.S. production flat to offset annual decline rates is about 600 drilling for oil and about 150 drilling for gas. And a lot of the wells drilling for oil will produce a lot of associated gas. And it was all the associated gas coming online in the Permian in 2018 and 2019 that drove down the gas price. And it's very, Steve mentioned, the gas prices rebounded, and it's because associated gas is going to fall off the cliff here next year. So this again is from the Raymond James report. This chart is based on their assumption that oil stays below 50. And I've said many times on my weekly podcast that $50 is an unsustainable price for the global oil market. We must have higher prices than that, or you're going to see steady decline. And so I mean, they show the rigs are in red, how many rigs were running, but see, we had an average during the year 2018 of over 1,000 rigs running, and we had that big spike in production. Now the blue is crude oil and the gray is NGLs. This is all liquids. And then because we started from an even higher place, once you start the year at a much higher level of production, the averages that goes into the average. So that had a lot to do with the increase in 2019, and also in 2020 we started at a very high point. But from the peak of 12.8 million barrels a day, we're probably going to drop about 3 or 4 million barrels a day just in the United States, So, if you ask Saudi Arabia to drop their production by 3 million barrels, they freak out, right? So that's a lot. But I'm thinking, before it settles down, we're probably looking at a 4 million barrel a day drop in the U.S. Now here's a chart saying that a vaccine, because they didn't know about the vaccine. So this chart was at the 1st of October, a month old, and they predicted a vaccine would come out by the middle of next year. A viable vaccine will be announced by the middle of next year, and by the end of 2021, you'd have demand back to normal. So if we can move everything up 6 months, and that the vaccine actually works, that'd be a pretty deal. But as you can see there, even if we went to $70 oil in the second half of next year, we still have a big drop off. And the reason is the public companies are under so much pressure to repair their balance sheets, pay down debt, but to return dividends and stock buyback programs to their equity holders too. So you listen to any third quarter conference call, and if they say free cash flow about 100 times on each call. They start out with it, they end with it, it's all through the middle, how much free cash flow and how they're going to do it. So now we're looking at global oil supply. And again, in the third quarter, we were draining the tanks by 2 million barrels a day. So inventory's going down. We're still draining the tanks, but not by as much. Let's say 500,000. So that minus 0.4, then 0.3 for the first quarter. And then it's going to start picking up as demand picks up and supply keeps falling. Now, once we get to about the middle of 2021, we have wiped out all the bars above the line. So we're back to normal, right? We're back to normal. Beyond that, that cannot happen. In the real world, that will not happen. So we have to have more than $50. Because if OECD inventories go to 25 days of supply, you're looking at critical risk in the supply chain, where refiners would not have any raw material to produce the gasoline and diesel and jet fuel and boat fuel and everything else this world runs on. So now this is global demand. And I could tell you, Al probably remembers this. I'll tell you what, when global demand hit 50 million barrels a day, which wasn't all that long ago. And I was working for Hess, went to work for them in 1983. And it was like, man, how's it ever going to keep going up that? If you'd told somebody demand's going to 100 barrels a day, 100 million barrels a day, well, where the hell, where is it going to come from? And it's really, thank God for horizontal drilling and fracking, or we'd be in big trouble. Because, they were real worried about peak oil and everything. I talked to a CIA agent who said he was on a cruise ship. I don't know. But he said the government actually came out with biofuels. They were so seriously worried about peak oil and what it was going to do to the economy. They were pushing that biofuels would wipe that out. Yeah, but then somebody forgot to tell them we need to eat too. We can't use all farmland for biofuels. So, but anyway, we've had a big drop off this year, and it probably by the end of the year it's not going to be 91.7. It'll probably be like 93 or something because it snapped back pretty quick. But once we get past COVID, assuming there's not COVID 21 or COVID 22, we're probably going to bounce back pretty quickly to 100. But I'll go on record here. The more people there are, the more demand for oil-based products. And Steve or Pat mentioned, when you go to these third world countries, they don't have this. They don't have electricity 24 hours a day. They find it hard to find enough gasoline for their car or their moped or whatever they drive. And they all want, they're on the internet. They know what kind of standard of living we have, and they want it. And those young people want higher standard of living, and that means more energy. So the demand for energy isn't even coming close to peaking because the number of people keeps going up. You know, with COVID, the number of people that usually die in the world each year is between 0.8 and 1.2 million or percent of the global population at the beginning of the year dies. Makes sense, right? We don't all live to 100. So 1% people dying here. We're at the low end. Even with all this COVID stuff, we're at the very low end for deaths on a yearly basis. So Google global population, and you'll get a chart that shows how fast it's going up. It's like 200,000 people a day, something like that. And guess what? Every human's an energy consumer. Squirrels and rabbits don't use this stuff. We do, and they all want it. And every kid wants a cell phone, right? God, so this is just another chart that kind of shows that. But this is an important chart to remember, that this is based on the assumption that the vaccine doesn't come for another 6 or 8 months. So if you push that up, probably you would have a higher rebound in the next year. See, it goes down 8.9% this year, but then bounces back to 5.5 million next year, the next year. So we get back. And again, this is just refinery utilization rate. And usually in the summer, we get up to about 95% utilization rate. And this year we've been below 80. We've been at low 70s actually. So that's why there's been less demand for crude oil. Okay, now I get this question. If AOC gets everything she wants, isn't oil going to go away? No, zero chance. Not going to happen. And please don't let AOC get everything she wants. Okay, now back to everybody wants energy, and the energy consumption is directly related to your standard of living. So those 4 bars, this is from a BP presentation looking out 20 years. Okay, what's it going to be like in 20 years? And then part of it is talking about the Green New Deal and how we'll affect how all these renewables. And there's going to be a huge increase in renewables, no doubt about it. And it'll probably get up to maybe 20% of total energy. But the pie is just going to keep getting bigger. The pie just gets bigger and bigger and bigger. And another thing to remember is wind and solar make electricity. We don't burn oil to make electricity, except for that little generator that comes on when you're, by the side of your house if you got it. So there's very few places in the world that burn oil to make electricity. And those places probably don't have the capital to put in big wind farms or solar farms anyway. So much of this environmental stuff is targeting coal. Coal is going to be the big loser in this decarbonization process. But the first 2 bars are the most realistic, where there's just a lot more renewable energy, but demand for oil, gas, and even coal continues to go up. I got a long report by, I think, Bank of America just the other day that said global demand for coal is still expected to increase for at least the next 5 years. And the reason why so many countries around the world, they have coal. Coal's everywhere in the world. Just dig down and dig it up, and coal's very efficient at making energy too. It's a cheap way to make energy. So they're building coal-fired power plants all over the place. I mean, China's building them like crazy, coal-fired power plants. So because they want to get electricity, all their people want electricity to their house. The one on the far right side is the most aggressive, and that is all the countries mandate that you get rid of coal. They mandate that you go to renewables, and also they penalize and tax people for carbon production like crazy. And That's the most extreme thing. And look what happens to oil and gas. Look what happens to the green and red bar. And actually, gas goes up. Gas gains market share and all that, because when you get rid of all those coal-fired power plants, you got to have something to make electricity, and it's gas. So gas is a winner in the Green New Deal. Okay, I do forecasts on a lot of companies, so I have to make some assumption on future oil prices. And I will say all my forecast models are Excel spreadsheets that you can download, and all you have to do is go to the bottom and change the assumption. So if you want to see what happens at $30 oil, what happens at $80 oil, you can just change the price assumptions for oil, gas, and NGLs at the bottom, and they automatically update the stock valuation and cash flow stuff. So right now, I'm assuming $40 oil for the fourth quarter, but most of these companies have a very high percentage of their fourth quarter production already hedged, and we are halfway through the fourth quarter. And the other thing is, I take into consideration differentials, like in the Permian Basin, the differential was real high, and you have to take that into consideration too. But for next year, I'm assuming like I'm actually a little bit below the Raymond James. They say 55 next year. I'm using 50, but I actually think we'll be into 60 by the second half of the year, hopefully. And then I just put, there's some forecasts by other companies. Goldman Sachs is Brent, is the European comparable. The futures contract in Europe is Brent, and they say 65. That's about a $2 or $3 premium to WTI. So if they had 65, we'd have 63 or $62 WTI. And Bank of America is the lowest one that I've seen, and they're even saying 50 for next year. There's the strip. Okay, now switch over to natural gas and NGLs. I think this is giving us a preview of what's going to happen next summer for oil, when it really becomes apparent that we're not drilling enough wells. We're losing supply at the same time demand is coming back on. And if so just since September, gas prices are up over 50%, actually about 57%, just since the end of September. So we have, the only thing that's holding it down at all is the fact that we do have storage about 200 BCF above the 5-year average, but that's going to be wiped out. If we have a normal winter, that'll be totally wiped out. And we're looking at a big deficit in storage by the end of March. And we're just not drilling enough wells, and the associated gas, like I said, is going to be dropping off. But so in 2019, now the natural gas market is growing at about 3 times the rate of demand that there is for oil, and all of our production has been able to be absorbed. Now it's come down, the prices come down, but it's been absorbed in the market. We're not flaring it or pumping it back in the ground or anything. It's been being sold, but at really low prices, got down to $1.50 or something. So compare that. Now the average for last year of 2019 was 100.4 BCF, right there in the middle of the page. But in the fourth quarter, it was about 105 BCF a day. Well, now EIA's last short-term energy report that just came out last week said the fourth quarter of this year, we're going to be at 97. So we're looking at an 8 BCF a day drop year to year from fourth quarter to fourth quarter. That's a big deal, especially when our LNG exports are doubling. So we're exporting more. And NGL prices, especially, they really took it up from second to third quarter. All the companies are reporting actual NGL prices better than I had forecast, every one of them. So this is the actual demand for U.S. gas last year, and it was 99 BCF a day. Now, think that, what did EIA just say? We're going to 95. We're below last year's demand. So how does this get fixed? You start rationing by price. They're already talking about utilities having to bring coal-fired power plants back on next summer. So we won't have the gas. The gas price will go so high, they'll bring the coal-fired plants back on. So our domestic demand was right there in the middle. You can see under 2019, we had 84.8 BCF a day of domestic demand. And look how much of it was electric generation. That's where we've had the big gains. Just in that, fifth, 14-year, it almost doubled. Then exports. We used to be a net importer of gas from Canada. Now we are exporting gas. So our Marcellus Utica gas is being piped into Eastern Canada, and we at 2.7 BCF a day, and then we have big pipes going down into Mexico, 5.1. So that was 7.8 BCF a day last year of pipeline exports. Mexico wants more. Mexico wants as much gas as we can give them almost. But the important line is LNG exports were 5.1 BCF per day. Here, okay, this is showing the huge decline, and we are about 4 bars from the right side because we're not completing enough wells, and the associated gas is dropping off the cliff. So demand's going up, supply U.S. gas going down. Here is the LNG chart. Now, there was a lot of noise made about how Asia was canceling shipments of LNG. They were backing out of their contracts. And so we had that big drop, and our exports actually dropped to about 4 BCF a day. Then there was some hurricane activity in there. I think there was this little girl named Laura, which caused quite a bit of problems in this area. In fact, see that the one there is gray, kind of looks like gray on the screen? That's Cameron. Hurricane Laura took a direct hit on Cameron. There was damage at the facility, and their power was totally knocked out. And they're just now coming back online. And so is Cove Point went off totally. And so those two are coming back online. So our export capacity is going to be about 10 BCF a day, and we're going to reach it. They want it. Asia wants a lot of LNG. Europe wants a lot of our LNG. And if we average 9 BCF a day, I saw a chart. If we average 9 BCF a day for the whole year, it would take our storage heading into the next winter would not be enough to make it through a normal winter. We couldn't refill storage next year. Okay. One thing about, you think oil prices flop around? If I did a max chart, there are spikes and valleys on this one that are all over, man. There's no straight lines on that, other than they go straight up once in a while. So as recently as February of 2014, natural gas went for $6, over $6. And as recently as just November of 2018, it went to $4.57. Now, there's some similarities there, but now we have a different story. That was just, we had a low amount in storage heading into a winter, and the winter forecast was supposed to be pretty cold, some El Nino thing. Anyway, so that caused traders to get a little panicky, and then the utilities start competing against each other, and that's what causes it. And again, this is the chart of the front month contract. So, they start bidding against each other for that supply. But we now have a structural problem. We don't have the supply. This isn't it's not going to be a weather thing this year. Now, weather could really cause a big spike, but going forward, we're not going to come close to the supply we had last year for quite some time, unless there's a massive increase in drilling. And I follow. EQT is the #1 gas producer in the country. They were asked multiple times in their conference call, are they going to increase their drilling program? No. Why should they? They hold all their acreage. They've gone out and put pads that could have 8 wells, 4 each way, and they drilled 1 or 2 to hold all this acreage. Why do they want to destroy the price? They want to bring price down? No, they sell gas. They want it to stay up high. So you got Antero, EQT, Range Resources, Southwestern, which is right up here someplace, and they control a lot of gas supply in this country. Okay, this is Raymond James' official gas forecast. Now, they've got one of the highest that I've seen for sure, but you can see they're expecting, because of the inability to refill storage next summer, they think by the 4th quarter next year, we're going to average $4 gas. Well, I can tell you, if you go to the models, if you go to a forecast model for EQT, plug in $4 gas. Plug in $4 gas for Southwestern down the road here, or Range Resources. They're printing money. Because that dollar, except for production taxes, goes right to the bottom line. And these companies produce 4 BCF a day. That's 4 million times $1 a day. That's a lot to their cash flow. So there's some pretty hefty companies out there. But even EIA says next year it's going to average, look at the very top. Their forecast is $3.13. I don't know how they come to that exact number, but one of their crazy formulas. So the summary is demand for oil and gas will bounce back to pre-pandemic levels if we just get past the pandemic. You know, people start traveling again, people, you know, eating again out and stuff. So oil price will move a lot higher in the second half, my prediction. Natural gas and NGL prices are moving higher now, and that's the near-term investment move I see, hopefully giving us a preview of what happens 6 or 8 months from now in the oil market. And they call them cycles for a reason. So I just want to tell you, if any of you are interested in our service, we have a newsletter every month. There's 3 model portfolios, kind of a large mid-cap one, small caps, upstream companies primarily, and then we have one for high yield. So a lot of midstream companies are in there. They're paying really good dividends. I think in our high yield income portfolio, the average is about 9 or 10% annual dividend yield. So one other chart. That's what I took yesterday. This is God's gift to America, friends. I'm telling you. Here's the 2 things that make America great, and it's not Donald Trump. Although I thought he did a pretty good job. But anyway, we have the most and best farmland in the world. The Mississippi Valley, all the way to the Rockies, almost all the way to the East Coast, is farmable land. Look at any other country. No other country has anything close to our farmland. And under that farmland, especially here, if it gets bad enough, I like the Republic of Texas, don't you? I think that's and then we could charge them a hell of a lot for this oil, right? But we got a lot of it. It almost covers the entire state. The red is gas, the green is oil. The Permian Basin is 19 million acres. So if you say it's one big oil field, it's one of the biggest in the world. And then you've got gas up there in Ohio and Pennsylvania, and actually goes to New York, but you know they won't let them frack in New York, so they're sitting on a fortune up there too. So we got a hell of a nice supply. So any questions? I'll take 2 questions. Yeah.
Hang on one sec.
How are these prices going up going to affect MLP pipeline stocks?
Well, they get paid for throughput. So if production starts going up, it has to go through their systems. Now, I would say the ones that are really have very healthy, balance sheets, there's some like ONEOK, Magellan, MPLX, ET, Kinder Morgan, they're solid, and they're going to be making money. So they may have to cut their dividends a little bit. Some of them have cut their dividends, but I track about 10 of them, and pretty much they seem like they're really committed to their current dividend yield. And because their stocks prices have come down, they're also there. So a lot of them are MLPs, so know what you're investing in if they're MLPs or C Corp. And a lot of them have switched over to C Corp, so you don't have to deal with the K1. So.
Hey, Dan.
Yeah.
What do you think about Iran being let back into the global community and the effect of their production would have on future prices?
That actually is my biggest fear with Mr. Biden, but I think he will be under a lot of pressure. And I read an article. If you send me an email, I will send it to you that goes through that. That's one of their things they discuss. And Iran has an election coming up. And we would like a new guy to get elected. And the Iranian citizens are not real happy. You think the average Iranian gives a dang about having nuclear weapons? The last thing they would want would be a nuclear war with the United States, right? I mean, I don't know, so they say, why are we pursuing this? Why are we doing this? And it's ruining our standard of living. So that's a fluid situation, that's for sure. But we would not want that. But I really do think they're smuggling out a lot of their oil anyway. So I don't think it would be all that much. And really, when I go back to like where we are going to be if our production keeps going down and all the non-OPEC, we're going to need every drop those guys can produce. We're going to need all the OPEC production is offline to come back online.
Dan, I don't know how to phrase this right, but pardon me if I say it wrong. Are all the forecasts take into account the people who will permanently work from home? Like, I know a lot of corporations have been making claims that they're going to let a workforce permanently remote. Does that even have a bearing on any of this?
Yeah, I'm a little bit of a bearing. But there's also the other thing, because people are afraid to go on mass transit.
Mm-hmm.
The people that are going, there's going to be more people who drive into work, and there's going to be more people taking driving vacations, which is less efficient than moving people on planes and trains. So as far as liquid transportation fuel demand coming back online, maybe 1 million barrels a day of that could be if let everybody work from home.
Okay. And another question real quick, Freeport LNG, train number 4, and I know any information about that you can share?
No, I don't really follow the LNG companies that much.
Okay.
So I don't really know where they stand, but I know there is 3 or 4 BCF a day of ones that are going to be built in the coming future. So it's a big market for the U.S. Yeah, but specifically on that one, I don't know.